So you're more than 20 years from retirement. Should you really be fearing a market downturn? No, you shouldn't. And there's all kinds of good reasons for that. You probably knew that to begin with, but let's just begin by defining what a market is. If you're thinking of just the stock market, if you're investing the right way, you should have money in more areas than just stocks. There's bonds, there's US stocks, there's foreign stocks, there are real estate investments. There are a lot of different ways you can invest your money. And so fearing a market downturn is something that is a little too broad of a fear. To get specific, if you're that far away from retirement, you should consider any opportunity to invest at a lower price is a good thing. And downturns will happen, but being afraid of it is really the wrong approach. Let's say stocks do go down and that's where you have a lot of money. If you've got time until retirement, continuing to put money into a portfolio and buying at a lower price is what you want. Presumably, prices will go back up before you retire, and that's a good thing. So if you've got a long enough time horizon, you should not fear that.
If you're more than 20 years from retirement and the market has a big sell-off, and again, that could be stocks, bonds, or real estate, but you continue to invest on a consistent basis. When the stock market rises, think of it this way: you would have bought everything as if it had been on sale. By continuing to invest in those assets that have been beaten down, you'll ultimately be well rewarded.
One of the big reasons you don't want to fear a market downturn is because when you react to fear, you sometimes make knee-jerk decisions. And when it comes to your finances, doing anything in a knee-jerk fashion is a bad idea. You could temporarily make a decision that causes you to permanently lose money. I'll give you an example. In 2008, a couple of years ago, a lot of people were affected when the stock market went down. We have plenty of people that we know that sold everything, sold out at the very bottom, and they decided they'd get back in when they feel more comfortable. Well, even today, they haven't felt more comfortable, even though the market's recovered and even gone up a considerable amount above the prices where they began before 2008. So don't make knee-jerk reactions and don't fear things. Think through them for the very long term.
Investors love it when stocks, bonds, and real estate go up rapidly, and they rarely complain when it happens that way. But you hear a lot about it in the news media and from your buddies at the water cooler when stocks and real estate and all investments are not working. That's not a time to get off course. Stick with the plan. Stay invested. Those are opportunities that will help you long term if you stick with it. Don't get whipsawed and sell out because there's panic in the streets.
Staying invested for the long term is easier said than done. But how do you stay the course? What's the easiest way to do that? Well, it's having a balanced portfolio. You've got to have a portfolio that has balances on both the sorts of investment opportunities that you're being presented to, or that you're being presented with, as well as a balance to the sorts of risks that you're taking. If in a good economy everything you own is going up, it's fun to talk about at a cocktail party, but at the end of the day, when things turn around, you may not have that portfolio doing as well. They could all be going down at the same time. So if you have a well-built, well-balanced portfolio, you should own a little bit of everything. At the end of the day, that'll allow you to sleep better at night and get through to the actual end result, which is the long term, retiring financially independent.